Well, good afternoon, everybody, and thank you for your patience. We had a couple little technical difficulties, and so we are going to go ahead and get started and jump right into it. I am really excited that we are beyond the presidential debates. I feel a sigh of relief from the country, and we are coming into the home stretch right now for the election. And no matter what side you're on, I think that all of us will be happy to get that piece of it behind us. And to get some certainty around which direction our country will be going, whether we are excited about that direction or not excited about that direction. One of the things that I will be talking about quite a bit today is that what we would like to see more than anything, and I've been talking to clients about this for probably 2 years now, is that people need confidence. They need confidence in their portfolios. They need confidence in the markets. And we still see people thinking that the markets are just about to fall apart, even though we have a lot of strength underneath us at this time. And so we will be talking about things that are going well in the markets right now, and we will be talking about things that we are excited about in the economy. One of the things that has been really wonderful to see is that we had a report come out from the Census Bureau that shows that real median family income rose 6% in 2015, and that is a really, really big deal. It is the largest gain that we've seen in almost 60 years, and it finally brings the income above the pre-recession levels. So not since 2008 have we seen median family income at the point that they are right now. And when families can support themselves and accomplish their goals, they feel a whole lot more confident. And so the labor market recovery that has been extremely slow has finally arrived at a place where we are starting to see wages start to go up. This will be an issue for us to continue to track internally and to consider what it will mean for the way that we manage portfolios, because a wage increase is the very first thing that we normally see before we see inflation. And inflation has been stubbornly low for basically the whole recession, so since 2008. Historical inflation over the last 50 years is 3.22%, and it hovers between 1% and 2% these days, depending on the quarter that we're talking about. So what we do need more than anything is the confidence and having our economy return to normal so that we can have our financial markets return to normal. And so we'll talk through some of that today. So we're very excited about some of the economic news that we have been seeing. We will certainly be paying attention to the election, and we'll be talking about some of that towards the end of the phone call. One of the issues that we are also looking at on the horizon and where there is some uncertainty is the Fed. And so the Fed had its first increase in interest rates last December. They raised it by 0.25%. There was a little bit of volatility around that after the increase, and then it pretty much settled down. And there was a forecast at the beginning of the year that the Fed would raise the interest rates 2 to 4 times in 2016. I said, absolutely no way are they going to do that. This Fed is very, very, very moderate, and they don't like to make any big moves unless they have absolute data to back it up. And in fact, they've made no other moves this year. And so they're looking at December, once we get beyond the election, as the first possibility of them increasing the interest rates. I don't have any concerns about it. I also don't fully believe that they're going to actually increase the rates in December. Every time that we get close to an increase in rates and there's anything that either says that the labor market is weakening or that the economy is weak or that there could be some sort of an international threat that would cause a long-term downturn in our economy, they do get very cautious about that and decide to just hold rates steady where they are. And I believe that they'll continue to use that excuse for a long period of time. The Fed does want the economy to get going again, and they really do believe that one of the ways to do it is to keep rates as low as possible, as long as possible. If they do raise rates, the assumption is that it would be only by 0.25% in December. If that's the case, it's pretty well baked into the markets already, both on the stock and the bond side, and we wouldn't have a concern about that causing near or midterm downturns in the market. But certainly if they get on some sort of a path where they're going to consistently raise rates, then it is something that we will be focusing on and go to more of a defensive posture, at least on the income side of our portfolios. We have also seen some good news in the earnings from the stock market. So we saw a decrease in earnings. We've had about 6 quarters now where we've either had a flattening or decrease in earnings, and the stock market in the end is driven by earnings per share. And so if the earnings are going down, that doesn't give us great hope for what we're going to see from the stock market. And there is a feeling now that the earnings are bottoming out and that we'll see a modest increase in earnings per share growth into 2017. So that is good news for us looking forward. We're going to go ahead and get started on the slides here and going through what we typically go through in our review. And so the here we go. All right, so the quarterly market review, we're going to look at the market summary, and we'll look at all the different kinds of assets that we would normally focus on, so U.S. and international stocks. We'll also talk about some interesting things that are going on with REITs. Now we have some striking numbers to show you from commodities, and then looking at global diversification, and then we'll end on presidential elections and the stock market. Looking at the market summary, an interesting piece right here, you see that the one red arrow, the one down arrow is in global real estate. One of the things that we talked about in the last quarterly review call is how the global real estate really has a very long track record, and you'll see that towards the end of the slides here, that global real estate has been one of the most consistent performers historically over very long periods of time, up to a 10-year period, which includes the 2008 downturn. So this past quarter, the third quarter, was actually great for the U.S. stock market with a return of 4.4%. The average quarterly return there is only 1.8%. International developed stocks and emerging stocks were really big winners in the third quarter, so 6.29% and 9.03% respectively. We have in our discretionary portfolios, we have reduced our exposure to international stocks because we feel like there is so much uncertainty around international stocks, and we really understand what's going on in the U.S. and feel like we are, despite the many things that have been talked about in the media this year about what's right and wrong in our country, we really feel like that we have a very solid stock market. We understand our financial markets, and that we have there's a lot of risk factors in the international markets that we have some concerns about, where we just don't know exactly which direction some things are going. So we have reduced our international allocation. The emerging stocks have had just an unbelievably fantastic year, but we'll drill down into some perspective on that a little bit further in the presentation as well. The U.S. bond market, it doesn't look like it has done well so far there, so 0.46% positive return in the third quarter. When we look at the U.S. bond market by sectors, we have some really interesting numbers to show you that might surprise some of you. So going on to the third quarter and some news that we saw in the third quarter. So as in every single quarter, we have both positive and negative things to be looking at. And so we had, starting on the left-hand side, the IMF, which is the International Monetary Fund. That's the third one from the left-hand side, calls for urgent G20 action to shore up the vulnerable global economy. So it's no secret that there's a lot of concern right now about the global economy. The IMF has been continuously pulling back on the growth expectations for 2016 and 2017 for what they see from the globe. We've seen negative interest rate policy, also known as NERP, at least around my dinner table. And negative interest rate policy, I've said it again and again, is one of the craziest things I've ever heard of in my life. And I can't believe it was ever implemented, and it's been implemented in very large countries to a very substantial degree. We saw Japan do it. They're still in the process of implementing NERP, but what we've seen is that it hasn't had the positive effect that these countries were hoping for. What they were hoping is that by having negative interest rates at a bank, which if you're scratching your head and thinking, how does that work? You give your money to the bank and you actually pay them to hold on to it. With the negative interest rates, what they were hoping that they would do is to move money out of the banks, that people would not want to pay the bank to hang on to their money, and it would motivate people to go either buy things or to invest in the financial markets. And I think that what the central banks are missing right now is, again, that people need confidence, and the reason that they would rather pay a bank to hold on to their money than to go spend it or put it in the financial markets is because there's a lack of confidence right now around the globe. The more that we start to see confidence come back, the more that we see that there are people who are running the ship and that are setting us on the right path and so on. When we start to see that, we will start to see some of these things turn around and we will get more normalized. But for right now, many, many things are off kilter a little bit. And what has been delightful to see is that the stock and the bond markets, especially here in the U.S., have actually done very well through all of this uncertainty. It's the investors that are not quite as certain about where they want to put their money. So we've had the IMF calling for urgent action. We had the Eurozone economy slowing in the second quarter. We also had the Bank of England expanding stimulus and cutting rates. We could see that as a positive. However, it's a negative because it's a response to Brexit. There have been some English people that I know, and some that might even be in-laws of mine, who believe that maybe the Brexit thing is something that's not as big as the economy is saying, or the global economists are saying that it's going to be. And people are saying, you know, maybe the Brexit thing is just going to come and go, and it won't be a big issue. We are not at the point yet where we have any understanding of how Brexit will affect either the British economy or the European economy or the global economy. So they haven't even started implementing Brexit at this point. And so once they start implementing Brexit and start figuring out how Britain is going to behave in the global economy once they're on their own and not part of the Eurozone, that is when we will start to see the effects of that. The Bank of England came in and cut the interest rates so that they could have a more free-flowing economy and that they would be as growth-oriented as possible. The Japan economy nearly stalls in the second quarter. You'll see that happening next. And again, they're trying so hard in Japan to try to get the economy going. It's been stagnant for so long, and they're trying many, many different things, and none of them seem to be working right now. And so at some point, Japan will get back on track, but they are putting a whole lot of effort into something that is simply not turning around. It has a lot to do with the population of their people and some other social policies and economic policies that they have over there. But for right now, what they're trying in Japan is simply not working. But right above that, exciting news. The Dow, S&P 500, and NASDAQ closed at records on the same day for the first time since 1999. And that happened this year. That happened this quarter. You wouldn't know that from the rest of the media that's out there, but that's a very positive thing for us to be looking at. If we go all the way over on the right-hand side, we see also that U.S. household wealth rises to a record, and U.S. household income surged 5.2% in 2015, the first gain that we've seen since 2007, which we touched on in the beginning. So there's a whole lot that is positive, and like I said, with every quarter there are going to be some negative things that we need to think about as well. Again, if we look at this, there's a whole lot going on globally that we have some concerns about, but the news that's coming out of the U.S. is actually pretty strong right now. What we're looking at here is the last 12 months, so I don't want to spend too much time looking back because we've done this on a quarterly basis, so you're all well aware of what happened each quarter and what's been affecting the markets. But it is interesting to think about how this year started out. So if you look at the time period between December and March and see that deep blue V that went down, we had a pretty ugly start to the year in the stock market, saw a pretty big correction, lots of big names calling for this being a repeat of 2008. And it was kind of the feeling that some nervous investors had that, oh, here it is, this is the time that the other shoe is going to drop, this is what we've been waiting for. And meanwhile, we've had this big surge in the stock market, not without volatility. We've had plenty of volatility along the way. But as long-term investors, we do have to consider the fact that headline news, a lot of times, is just that. And if we stay invested through the markets, that will provide a more balanced approach and will be a lot less stressful for the majority of our investors. Moving on to the world asset classes, so it's interesting to see what we're looking at here. We saw some things do well, which we haven't seen in a while. The Russell 2000 is more of a small cap index, and then we have the emerging markets index that had a return of 9.03%. And then the Russell 2000 Value Index of 8.87%. So those are big numbers. The Russell and the emerging markets, those are certainly on the riskier end of the investment spectrum. And so those did give us a great return, but most people are not going to have portfolios that are overweighted in that area. So we do have exposure to those areas, but they are a much smaller allocation in our portfolios because we are not high risk investors. And again, interestingly, if we look all the way at the bottom, the Dow Jones REIT Index was actually negative 1.24% this quarter. We have had nice, strong, consistent returns out of real estate for a long period of time, and so it's just interesting that we see that we have one quarter that it's negative there. The we talk about this all the time. Past performance is no indication of future results, and this chart really shows that to us. So there are a lot of charts that we've looked at over the last year where these numbers would be going fairly in the opposite direction. And at this point, this is just a good reminder that we do want to have a variety of asset classes in our portfolio, because even those of us who have been doing it for nearly 20 years at this point still don't know quarter by quarter which one is going to perform the best. So So we want to make sure that we have good risk-adjusted exposure. Now let's look at the U.S. stocks. So this is for the third quarter return. So what we're looking at here is an index. These are not specific to our portfolios. These are different indices, and if you want to know exactly which indices, you can read the fine print at the bottom of the slide there. Across the board, there's been pretty good returns year to date in the U.S. stock market. The one-year returns are fantastic, and I don't want to get too excited about those because if we look back a year ago, it was right after China had just devalued their currency, and there was lots of volatility in the stock market. So that was starting from an extra low point to where we are right now. So those numbers are not the sort of numbers that we would predict going forward. But if we look at the 3-year returns, the 5-year returns, and even the 10-year returns, which do include 2008, those are pretty strong 10-year returns. Now, again, this is just the straight U.S. stock market. This is not a diversified portfolio. We'll get to those return numbers at the end, but this is just straight U.S. stock index. And if we think about the way that most investors are feeling these days, they don't feel very confident about their the stock side of their portfolio. There's a lot of concern about when are we going to go down again, when are we going to have another 2008, what's going to cause it to fall off. And when we look at these numbers, which are just pure indices, this is data. You know, this is just information that tells us that the stock market actually, even incorporating 2008, has provided very strong returns over a very long period of time. On the international developed stocks, it's a slightly different story. In fact, it's a very different story. And again, when we talk about why we're reducing our allocation to international, this is a piece of it. So if you look at the year-to-date numbers, they're okay. They're not that strong. The small cap returns have been the strongest, but small cap international is not really where we focus anyway. So the year-to-date numbers are certainly lagging what we would see on the U.S. stock market. The one-year numbers are the same. They're not as strong as we saw in the U.S. stock market. 3-year numbers are even negative on the value side. And then the 5-year numbers, those are pretty good, consistent numbers, but if you look at 10 years, they're not. And so there are certainly times that international stocks have added to the portfolios, and there are certain times that the international stocks really have pulled down the overall return of the portfolios. And that, again, goes to why we have reduced the allocation there, and we're being much more selective and willing to reduce it even further in the future. So we have had some good returns this year, but it's not something where we feel like we're turning the corner and where international is going to give us better returns than the U.S. stock market moving forward. So here's the fun and somewhat unexpected story for emerging market stocks this year. The year-to-date numbers are extremely high. So we do have some exposure, especially in our discretionary portfolios, and in some of our higher growth portfolios, we have exposure to emerging stocks as well as some exposure to emerging bonds. Again, the one-year numbers are great. If you look back to what was happening 1 year ago, a lot of the emerging countries were affected by what China did, and so they had a huge downturn at that point. So again, those numbers are a little bit skewed if we think about what was happening a year ago. But even incorporating the one-year numbers and the year-to-date numbers, the 3-year numbers are not good. They're either negative or they're basically flat. 5-year numbers are not that great, and 10-year numbers are not that great. The 5 and the 10-year numbers are really not much better than we would ever expect to see in a long-term bond portfolio. So for the risk that you have and the volatility that you have in emerging markets, it is a bit of a timing issue about when you're in them and when you're out of them. Again, goes back to the fact that we have reduced them, and we don't expect to increase our sleeve to the emerging market stocks anytime in the near future. Here are the emerging markets by country. And so the interesting story here, when I was looking at all of these numbers when I was preparing for this call today, I looked at the emerging markets on the right-hand side, the emerging market returns, and on the left-hand side it's the developed market returns. And I thought, why on earth is China still considered an emerging market? And so I did some research on it, and it is still considered an emerging market for most market watchers. There is some consideration that it really should be moved over to a developed market because the size and the breadth and the output of their economy. But because of the stage of development that China is in, they are still not considered a developed market. So a developed market really is going to have more of a service point of view than goods. And China is still very much focused on goods and is trying to move towards more of a service economy This is something that we've known. They've been very clear about this. They know that this is the next piece of development for them, but it is going to take 10 years or longer for them to really make that transition, and it will happen in fits and starts. And so China was one of the big drivers of the global economy for many, many moons, and people would talk about the double-digit returns that they had in their economy, and then it was that China was only having a 9% growth year, and then they were only having a 7% growth year. They're probably in a 4 to 5% growth year at this point, and that's what we should expect going forward. So that is one of the reasons that the global economy has slowed down, is simply because China has slowed down as their economy does continue to evolve into more of a service economy. And here we are now with the real estate investment trust. And so we did spend some time talking about this last quarter, and the real estate investment trust, if you look at the return numbers there on the bottom right-hand side, year-to-date numbers are still strong, even though this quarter I showed you at the beginning was slightly negative. The 1-year, the 3-year, the 5-year numbers are all fantastic. The 10-year numbers obviously take into account the 2008 downturn, which was the largest downturn that the real estate market has ever seen. And so even incorporating that, the return for U.S. REITs is 5.8%. And since then, over a 5-year history and even shorter, the returns have been double digits. And so we have been very pleased to have real estate in our portfolios and tend to continue to increase that. It is considered, real estate is considered an alternative asset. So there are limitations to how much we can put in any of our clients' portfolios, and quite frankly, how much would be prudent to put in any of our clients' portfolios. But this will continue to be a focus for us going forward. If we look at commodities, you could spend some time looking at that, but really you could just look on the left-hand side and look at the period returns and understand why we have zero exposure to commodities in our portfolios. 1, 3, 5, and 10 are all negative and really negative, not slightly negative, they're really negative. Year-to-date is positive, but in that sort of a perspective of a 1, 3, 5, and 10 being all negative, that is not something we'll be adding to portfolios. The thing that's been interesting to me this year is that even with all the concern, or at least the concern that the media has been telling us that everybody has, and all the uncertainty around the election, that gold has not had a better year than it has this year. So it has a slightly negative performance for the third quarter as well. On fixed income, so here's the other piece that's really interesting, at least for someone like me who loves to study the financial markets. If we're looking at the period returns on the year-to-date returns, so again, these are different bond indexes that we like to look at, but look at the difference between the Bloomberg Barclays Long U.S. Government Bond Index, 14.61% year-to-date return, versus the Citigroup 1 to 5 years hedge to the U.S. dollar index, which is only 1.98%. That is a massive difference in returns. And also, if you look at the Barclays U.S. Corporate High Yield Index, that tells us another story. So I believe there are two different stories going on right now in the bond world. The reason that the market returns are so high on the long U.S. government bond index, right now there's so much debt, people talk about it all the time, the debt of the U.S., terrible, we'll never get back on track with it. Why would anybody ever invest in it? It's because it's all about security. So it is considered one of the safer investments that's out there next to cash. And there are people who are simply looking to not have very much risk exposure right now. So I think that that is just people, again, looking for confidence in their investments and feeling like they want to be in something that is very low risk. On the corporate high yield index, the returns that we're seeing there, there's two different things that I think are going on there. If you look at the year-to-date number at 15.11%, and then the one-year number of 12.73%, if we look back a year ago and what was happening with oil, and even through the beginning of this year, oil has been taking a beating and finally bottomed out in the first quarter of this year. That corporate high yield you may also know as junk bonds. And so a lot of the bonds that were associated with energy companies will fall into the high yield or junk bond category. And so some of those bonds lost value, even if it was temporarily, when oil was dropping so much. And so that really had a lot to do with what was going on in the high yield market up through February, March of this year. So that has had a big rebound this year. The other piece of it is that because the Fed has kept interest rates low for so long, it's very hard for anyone to be able to find really good income anymore because we've just had these rates that have been so low for so long. And so investors are reaching for more income. So if their focus is still income, they are willing to go further out on the risk spectrum to be able to get it. I don't agree with that personally, again, because we are not high-risk investors. We have clients who really want to preserve and grow their portfolios modestly. We don't have clients, we don't tend to have clients that are very, very high growth and have very high expectations of beating indices and so on. And so we don't have to compete with that very much with our clients. But for people who are saying, I still want very high income and I'm willing to go out there on the risk curve to be able to get it, a lot of money has poured into the corporate high yield. My concern about that is that market can be very strong. It can also turn very quickly. So I'm generally not a fan of investing in that part of the bond market, but certainly, as you can see, it has had a great return this year and over the 1 year, and even the 3, 5, and 10-year numbers have been very strong. You just see more volatility in that part of the bond market than you do in other parts of the bond market. So let's look at global diversification, because this is really a more appropriate comparison for most of our clients. We don't tend to have clients that either are 100% stock or 100% bond. So we do have clients that tend to fall more in the 50-50 asset class, or somewhere between 75 and 25 stocks to bonds, or 25-75 stocks to bonds. So if we look at just the 50-50, which is just a pure balanced portfolio, and again, this is not our portfolio, these are indexes that have been blended together to give you some perspective about what's going on in the market right now. A 50-50 asset allocation is going to give you a return year-to-date of 3.7%, and then the 1-year return is 6.43%. If we look back long-term, the 3-year is 3.0, the 5-year is 5.7, and the 10-year return is 3.21%. Obviously, we would love for those numbers to be higher, but again, this is not us saying what we can deliver. This is just saying what the market has delivered over that time period. If we look at what the stock has done, if we go to a 100% stock portfolio, which the majority of our clients, again, are not invested in, the year-to-date is 7.09. It's interesting to note that on the 10-year return, there's not much difference between the 100% stock portfolio and the 50-50 stock portfolio. The 10-year return on 100% stock is 4.9%, and the 10-year return on 50-50 is 3.21%. Historically, we would expect to see a much bigger spread there. So two things that I want to bring to your attention. If you look at, with those numbers in perspective, if we look at the box that says growth of wealth, the relationship between risk and return, and you see the brown and the blue lines, to me, it's the comparison is how much do you like to be on a roller coaster. So I don't love high roller coasters personally. So the blue line is a really big roller coaster. That's like the Texas Giant out at the State Fair, or at the at Six Flags. So for people who really like that, who love the thrill of the up and down of the market, that's a great place for them to be. If they really enjoy that, they can handle it, they're going to stay invested, then over time, the portfolio, by comparison, if you look at the numbers, in every one of the year-to-date, 1 year, 3 year, 5 year, and 10 year, the returns have been stronger than any other mix on the portfolio. But what happens is that most people don't like that roller coaster as much, and so if they get into the parts where you can see where the roller coaster goes down and has big downturns in 2001 to 2 time period, and then obviously around 2008, people tend to pull out of the market. And so that's not healthy for their returns over the long term, because they have to pull out of the right place and they have to get back in at the right place. And so hardly anybody can time that very well, and so it is much more important for people to stay invested, which is why a 50-50 portfolio, and again, I like smaller roller coasters myself, the 50-50 portfolio is the kind of portfolio that can help people to stay invested, because you don't have nearly the ups and the downs. We talk a lot here about how we don't want to have desert weather. We don't want it to be 120 during the day and 40 degrees at night. We'd rather have San Diego weather, where we have some mild variations, but we don't have quite as much risk and we don't have quite as much volatility, and therefore our clients can feel confident that they can be invested for a longer period of time. So we do have, we deeply believe in global diversification. We deeply believe in our clients staying invested. We certainly do manage around what we believe is going to happen, what we believe is both going to do well in the market over the next 12 to 18 months, and the pitfalls that we also might be coming up against in the next 12 to 18 months. So it's not that we want everybody to stay in the exact same portfolio for a 10-year period of time, but we do want them to stay invested. And so it's very important to us that all of our clients have the right risk level in their portfolios at all times. So now let's talk about what's on everybody's mind, which is the presidential election and the stock market. This is a really, really interesting chart, although it'll take you a little bit of reading there to be able to understand what's going on. If you look at this, it's just a chart that tells you what the returns have been in any time period. So this is monthly returns in any time period, not just during the election years. So then the presidential election years, so there's the red is the month that a Republican won, and the blue is the month that a Democrat won. The conclusion here is that the election month returns are within the typical range of returns, regardless of which party won the election. So there is so much discussion right now about which party is going to be better for the stock market, which party is going to be better for the economy, and so on, and really the answer is it depends. So there is not really good, strong evidence that we will see any sort of an immediate reaction once the election comes and goes. The general consensus in the financial world is that because we know really, really a lot what she is like and what she would do, and she's been fairly clear about what her policies would be, that there would be less volatility or reaction in the immediate aftermath if she were to get elected. Trump, on the other hand, is a little more volatile. He would probably have a little more volatility just because there's not clarity around what his policies would look like. And so the feeling is that we should brace ourselves a little bit if Trump is elected, because the markets will still be trying to figure out what direction he's going. And with Hillary, again, she's pretty obvious about what she's going to be doing. The good and the bad news is that it normally takes about 18 months for someone to get elected, to actually get their feet wet, get their policies in place, and then to do anything that's going to actually affect the economy. So we generally don't expect the president to affect the economy for at least 18 months. I think Hillary knows how to get things done in Washington, and I'm an independent person politically, so I'm not saying that I'm for or against her. I'm just saying I think that she knows how the sausage is made in Washington, and I think that she will be faster to implement things maybe than Trump would be. And so it's possible that we would see some of her policies go into effect and start to affect the economy earlier rather than later. From a perspective for us, I don't have a strong opinion right now about any changes that I would make on the portfolios with respect to either one of them being elected. I have very clear ideas about what would happen from a tax perspective if either one of them is affected, and I think that that really is how we can add the most value for our clients, is considering what the tax code changes would look like and how we can help them to get more defensive about that. And what you'll see here is this is a mountain chart to show you what the Republican president versus the Democratic president has done. And I think every Democrat I know says that the stock market performs better under Democrats, and every Republican I know says that it performs better under Republicans. This shows that no matter who's in office, there's ups and downs in the stock market. And so while we certainly are focused on what's happening with the election, we are more focused on what's happening in corporate America and with the tax code and with what the Fed is doing. So that is going to be more our focus going forward. And honestly, we'll just be so happy to get it behind us. I think that one of the things, well, we know that one of the things that the stock market hates the most is uncertainty. And so even just getting the election behind us, I think, is going to be a positive for the stock market, because at least we'll be able to start to assess what does that look like and where do we need to be invested going forward. There is an interesting chart that I saw, which was a chart from FactSet. And it shows the annual S&P 500 returns by political party control. This is from the years 1945 to 2015, so it's a very long time period. Some of that may no longer apply to us, but it was interesting to see that the highest return, so what they were looking at was the combination of president and then Senate and Republican and who had control. And so the highest return combination was that we would have a Democratic president, Democratic Senate, and then a Republican House of Representatives. And it's very possible from the polls that I'm reading that that's exactly what our setup would be. So who knows if that portends anything good for us in the future, but certainly I don't want any of our clients to think that just because either one of them gets elected that that's going to be necessarily good or bad for the economy or for the stock market. And no matter what is coming ahead of us, we are going to be well prepared for it, and we're going to be relaying to you what our opinions are and where we either think we have growth opportunities or where we need to think about getting a little more defensive. So that brings us to the end of our report today. I really appreciate you spending the time with us, and I appreciate the confidence that you have in us. We will continue to bring you lots and lots of education materials as we go through the end of the quarter and then coming into 2017. We appreciate so many of you that have been clients with us for so many years and can look back and say, oh yeah, I remember back in 2005 and in 2007 and 2010, and when we talked about all these things. We have a whole lot of clients that have been with us for many, many years, and it's important to us that you've been a part of our family and that you continue to be a part of our family. I hope you have a wonderful day and that you enjoy the rest of your fall, and we'll be talking to you next quarter.